Hi, welcome to the Crypto Republic. Before we dive in, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Let's get straight into it. What I'm about to show you about Ripple and XRP is something the mainstream still isn't ready to admit. This isn't hype, this is math and history and infrastructure converging. And if you're sitting on the sidelines, this could be like watching the Panama Canal being dug and saying, nah, ships will just go around Cape Horn forever. Big mistake. For years, Ripple has been building pipelines underneath the financial system, corridors for value to move instantly. Most people only see the headlines about lawsuits and price charts. They don't see the plumbing. But that plumbing is exactly what created global trade, booms in the past, like the telegraph cables in the 19th century or SWIFT in the 1970s. Now it's happening again, but faster, digital, tokenized. And XRP is the settlement fuel. When Ripple launched its fiat-based network, banks were excited but cautious. It was like the early days of the internet, useful but limited. Then Ripple quietly designed a flip switch, on-demand liquidity, ODL. Instead of pre-funding accounts across the globe, ODL would let institutions instantly source liquidity using XRP as a bridge asset. But here's the kicker. For it to work at scale, the market cap and transaction volumes have to be orders of magnitude larger. That's not speculation, that's a settlement float requirement. Think about the gold standard in the early 20th century. Countries didn't settle with bars of gold on ships every day. They needed a working float of gold in major clearinghouses to back up massive trade volumes. Same thing here. Only a fraction of XRP supply is liquid at any time. The more global flows go on chain, the more the working float must expand, which mathematically pushes us the price per unit. This isn't moon boy math. It's exactly how clearing systems scale. Even conservative frameworks, like the ones built by major analysts in 2018, massively lowballed XRP. They only counted three markets: FX, corporate payments, and retail remittances. They left out tokenized treasuries, stablecoin corridors, sovereign bonds, and digital money funds. There are trillions in daily flows coming online by 2030. Under even mid-range assumption, XRP's daily settlement volumes could dwarf those old projections. Look at today's metrics. Even at single-digit billions in daily volume, XRP prices have already adjusted upwards. When you model 20, 50, 100 billion per day, which is peanuts compared to FX markets, you start getting the prices the skeptics will call impossible. Yet we've seen this hockey stick adoption curve before, in internet bandwidth, in smartphones, in stablecoins. Liquidity begets liquidity. Here's the part that gives me the chills. This is the first time in financial history where retail discovered the infrastructure before institutions. In the 1800s, telegraph cables were laid by governments and banks. In the 1900s, Fedwire and SWIFT were built by central banks. But today, retail holders front-ran the pipes. You and I are literally holding the settlement asset before the big players fully flip the switch. Let me break this down simply. Imagine a bridge designed for 10 cars a day. Now the government reroutes 100,000 cars onto it overnight. Either the bridge collapses or you rebuild it wider. In token terms, either the float multiplies or the price multiplies. Supply is relatively fixed. Retail holds a chunk off market. As corridors scale, price must adjust upward to maintain the same liquid capacity. Governments are plotting digital bonds. Asset managers are launching tokenized money funds. The IMF and BIS are publishing frameworks for cross-border CBDC settlement. All of these pipes converge on the need for a neutral liquid bridge asset. XRP is not the only candidate, but it's the only one ready, embedded in dozens of corridors, and tested at institutional scale. Nobody else is this far ahead, not even close. We're at a generational inflection point. Think about early railroad stocks in the 1800s, or Cisco routers before the internet boom. People laughed, then fortunes were made. If you wait until flows are in the hundreds of billions per day to feel safe, you'll be buying at the institutional top. This isn't financial advice, but history rhymes. In the next 12 to 24 months, watch three signals: tokenized treasuries and money funds crossing 1 trillion assets under management, major FX corridors flipping to ODL for real-time settlement, regulatory frameworks clearing the path for wholesale use. Each one accelerates the float requirement and the price reaction. This is not hype. This is the math of settlement systems colliding with the largest upgrade to money rails in a century. If you found value in this breakdown, share this with your network. We're documenting this transformation in real time before it goes mainstream. If this opened your eyes, smash that like button, ring the bell, leave a comment with your thoughts, turn on notification, and most importantly, subscribe to the Crypto Republic, bringing you the truth about XRP, global banking moves, and the wealth transfer already unfolding. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic.